Assalamu alaikum. Bismillahirrahmanirrahim. Let us student discuss this question, Juanita. Let's see what the question says. First, we'll be reading the question on this OneNote, and then we'll be solving this question, inshallah, on Excel. Okay. Let's see what are the requirements. It's a 20 marks question. Required advice. They're asking the advice. You can give the one advice. What is that advice? That don't take advice from us, but never write such things. Okay. You will not get marks for writing the true things. Advise Junita of the reduction in inheritance tax liability arising on the Don's death in respect of the shares in Easter Limited as a result of Lexi having received her shares as a lifetime gift rather than on the Don's death. 8 marks. Advise Jonita of the reduction in IST liability. You have to advise her how much tax Jonita is going to save on IST liability which will arise on the Don's death in respect of the shares in Easter as a result of Lexi having received her shares as a lifetime gift rather than on Don's death. It gives you 8 marks. Let us read the question for first for part A, then we'll come to B as well. No issue at all. You should assume that today is 1st August 2022. Okay. Jonita has contacted you following the death of her husband. After the death of her husband, she has contacted you. Dawn. Wow. As the executor of his estate, she is seeking advice regarding the inheritance tax liability arising as a result of his death on shares which he owned. She also requires advice on the timings of her ceasing to trade. Okay. Dawn died on 1st July 2022. Had always been UK resident and domicile. Whoever is UK resident and domicile, that particular individual needs to pay tax on his or her worldwide income. Was married to Jonita and they have one daughter, Lexi. Just one daughter, Lexi. Okay. Lifetime gifts. Dawn made. This is made. Dawn made only 2 lifetime gifts. On 9th May 2017, Dawn gifted his overseas villa to Lexi. 9th May 2017, which falls in the tax year 1718. Dawn gifted overseas villa to Lexi. Okay, that is her daughter. The villa was valued 3,55,000 on 1st May 2019, which means the entire nil rate band 3,25,000 obviously will be consumed by this villa, and annual exemption of 1718 and 1617 will also be given on this villa. Okay, and 3,70,000 on July 2022. Very important. When someone is given gift in his or her life, then whatever the value comes at that time, that value ceases. On the same value, you have to pay death tax. Basically, once someone is given the gift during his lifetime, then on the death of this individual, on the death of the donor, if the value of the asset increases, we never take the increase, we never account for increase in the value of the asset once it was gifted during the lifetime of the donor. But on the other end, if the value decreases on the death of the donor, then donee does get fall in value relief. So fall in value relief is available if the value reduces, but if the value increases, so no issue at all. So we still have to take the original value, that is The value which you have transferred, obviously after deducting annual exemption of the current year and the previous year. On 1st March 2019, on the advice of a financial advisor, Don gifted 3,500 of his shares in Easter Limited to Lexi. 1st March 2019. Hold on. 1st March 2019. Dear student, this 1st March 2019 falls in the tax year 1819. 1st March 2019 falls in the tax year 1819, which means the villa was gifted in the tax year 1718. So obviously annual exemption of 3,000 of 1718 consumed by the villa. Then 1617 annual exemption is consumed by the villa. When it comes to shares 1819, whatever the value of the share is, we will deduct annual exemption of 1819, but we will not be able to get the annual exemption of previous year, last year, because 1718 annual exemption is already being used against the villa. Okay. So there are two lifetime gifts. One is villa, another is shares. Villa was gifted in 1718 and shares were gifted in 1819. Prior to receiving this advice, Don had been planning to leave these shares to Lexi on his death. Before this advice, he was planning to leave all the shares to Lexi on his death. Under the terms of the Don's will, Don's cousin will inherit the remaining 3,500 shares in Eastern Limited owned by the Don at his death. It means Don is having total 7,000 shares. Because he has gifted 3,500 shares to Easter, and on his death remaining 3,500 shares will be given to the Don's cousin, which means that altogether he is having 7,000 shares. Easter Limited is an investment company. No business property relief is available. So you will not be getting any BPR on the transfer of its shares. Before the gift on 1st March 19, Don owned 7,000 ordinary shares in Easter Limited. Okay. Before the gift, he was having 7,000 shares. The remaining 3,000 ordinary shares issued by Easter Limited are held by Juanita, who is the wife of Don. Now listen and listen carefully. Whenever you have been given information like this, you should, this information should give you a really good hint of related party, basically related property rule. Related property rule. Because husband and wife both are having the same company's share. So related property rule will definitely apply. And look at the information. They have also given us the information. The shares were valued as follows. Percentage shareholding. Value per share on 1st March 19 and 1st July 2022. Okay. Jonita. Now this is relating to the business. I'm not reading it for a moment. Now read the question again. Advise Jonita of the reduction in her inheritance tax liability arising on the Don's death in respect of the shares in Easter Limited as a result of Lexi having received her shares as a lifetime gift rather than on Don's death. Now listen and listen carefully. We have to simply explain what benefit or what amount of IHT is saved due to giving 3,500 shares gift to Lexi in the life of Don. Okay. The first point is, look at this. Actually, Don died on this. The death of the Don is this. Don died in the tax year 2223. Okay, number one. When it comes to death tax, a very important point is basically on death tax, there will be no nil red band. Why? Because that particular nil red band will the particular nil rate band is already consumed by this gift of the villa. Okay, which means that on this 3,500 shares, the tax which we are going to calculate, the rate of the tax will be 40%. Why 40%? Because IST on death is 40%. Second, no nil rate band is available. That nil rate band will be already utilized, already consumed by this villa. If I explain you a little bit, just a minute. Let me explain you so that you should get a really good idea. How much tax is saved and all these things. For that I want to go to Excel. Just a minute. Let's go to Excel. Okay, that's good enough. We are solving part A of the question. Okay. Let me show you lifetime tax. Lifetime tax. Number one, gift of villa to Lexi. In tax year, this villa was given in the tax year, just 1718. 1780. Value of transfer 3,55,000 less annual exemption which is 3,000 less annual exemption of 1617 last year annual exemption. Since this gift was given to Lexi during the lifetime, it is PAT and we don't pay any tax on PAT in lifetime. So whatever comes, that will be the gross chargeable amount. This will be the gross chargeable amount. Which is 3,49,000. Okay. Basically, we have to just explain what benefit, how much IST will be saved just due to giving 3,500 shares as gift to Lexi during the lifetime. I just wanted to show you this lifetime also so that you should get a really good idea. Now the gift of shares. Gift of shares 3,500 to Lexi. That is also obviously PAT. In tax year 1890. Okay. Now the value of this 3,500 shares we will calculate by using related property rule. Now try to understand this. 7,000 shares are with Don. 3,000 remaining shares are with Juanita. It means altogether if I add both of these, so they both combine, they are having 100% holding in the company. Because you read the question what it says. It says Don is having 7,000 shares and after that they are saying remaining shares are with Juanita. It means the company has issued only 10,000 shares. So if I add together, so they are having basically 100% holding. So how to calculate the value of 3,500? Because we need to calculate the diminish in value, how much decrease in the wealth comes. It's very simple. First we'll be calculating the value before the gift and then value after the gift. The important point is before the gift, the share price will be 20 of 7,000 shares. Why? Because before the gift, the holding of Don plus Jonita combined, it is 100%. So the applicable share price is 20. But after the gift, as soon as Don will give 3,500 shares as gift to Lexi, so Don will be having 3,500, remaining shares 3,500. Jonita will be having 3,000 shares. It comes to 6,500. The company is having 10,000 shares, and after giving 3,500 shares as gift to Lexi, combined shares of Don and Jonita will be 6,500, which means 65% holding. Then applicable share price after the gift is 15. Applicable share price after the gift is 15. So let me show you. Just a minute. Azan break. Okay. Azan is done, alhamdulillah. Okay. Now let us first show the value of shares before the gift. Value of shares before the gift. Basically, before the gift, they are having 100% holding, and applicable share price is 70, or applicable share price is 20. Value of shares before gift. Just a minute. Basically, Don is having 70% holding. Don is having 70% holding, and his wife is having 30% holding. Which means altogether they are having 100% holding, and applicable share price is 20. And we are having 7,000 shares. Simply we can do this. 7,000 shares multiplied by 20. Now less value of shares after gift. Value of shares of value of 3,500 shares after the gift. After the gift, the holding is different. After the gift, basically John is having 35% holding. Wife is having same 30%. It comes to 65. And in case of 65, the applicable share price is 15. So here comes the diminish in value, the reduction in value, the reduction in the wealth. Diminution in value. There's 140 minus this. Now only annual exemption of 18-19 is applicable. Basically annual exemption of 17-18 is not applicable because it is already being used by the villa, which Don has gifted during his life earlier than the gifting this 3,500 shares. So less annual exemption of 18-19, 3,000, less annual exemption of 17-18, 0. It means the gross chargeable amount. Just use the sum formula. This is the gross chargeable amount. Now listen and listen carefully. What happens on death of Dawn? Basically, since Dawn is died, or Dawn has died within the 7 years of making both of these gifts. So on the death of Dawn, both the gifts will become chargeable. So obviously, number one, villa will be taxed, and villa will consume entire nil rate band of 3,25,000. And there's no need to show any calculation on the villa. Just will be showing a you need to just show the discussion. The main question is how much tax is saved due to giving 3,500 as gift to Lexi during the lifetime of Dawn. Okay, so obviously we'll be explaining that applicable tax rate on gift of 3,500 share is 40% because either these shares are given to Lexi on the death of Dawn or before the death of Dawn. Why 40% is applicable in both the cases? Because the nil rate band is already consumed by the villa. Okay, but obviously the value differs. The value differs. If Dawn has given these 3,500 shares, let's say if Dawn has left these 3,500 shares on his death for Lexi, then obviously the value would have been different. So we need to explain these things on MS Word. Little bit calculation I want to just show here, then I'll go to MS Word for referencing. Death tax IST payable on 3,500 shares given as gift to Lexi. I'm not showing any tax on villa because obviously I have to pay a little bit tax to on villa as well, because the question is specifically relating to shares. The question is how much tax, basically how much IST is saved due to giving 3,500 shares as gift to Lexi. That is why I'm not showing any calculation of villa. So simply we'll take this into 40%. Okay. Now we'll deduct the simply taper relief. The gift was given on 1st March 2019. Okay. And Don died on 1st July 2022. So basically, gift was given on 1st March. Shares as gift, they were given on 1st March 19. And Don died on 1st July 22, which means if you go ahead 20, 1 year, 1st March 20 is 1 year, then 1st March 21 is 2nd year, then 1st March 22 is 3rd year, and he died on 1st July. So it's going to be 3 to 4 years. The gap of gift during lifetime and death is 4 years, and on 3 to 4 years the taper relief is 20%. So less taper relief, basically 3 to 4 years. So we'll take 20% of this. After the taper relief, IST payable by Lexi. How much Lexi will have to pay? Actually, Lexi will have to pay 27,040. Lexi will have to pay 27,040. Okay. Still 3,500 shares are left, and it is written in the Dawn will. The remaining 3,500 shares will be given to the cousin of Dawn. But obviously he died on 1st July 22, so we'll take that value. Now, number one, after giving 3,500 shares as gift to Lexi, the remaining shares are husband and wife. Remaining shares are 65,000, which gives them 65% holding. So applicable share price on 1st July 2022 on remaining 3,500 share is 18, and whatever the value comes on that value, 40% will apply. And obviously there will be no taper relief because remaining 3,500 shares are given as gift on the death of Dawn. Okay. IST on remaining. IST on remaining 3,500 shares on the death of Dawn. So we'll take simply 3,500 shares. Applicable share price is 18 and simply apply the 40%. So it comes to 25,200. So altogether the total tax is altogether total IST. Total IST is 25,200 plus this. This is the total IST. Now listen, if these shares were not given as gift during the lifetime, then what happens? Then entire 7,000 shares will be given as gift on the death of the Dawn if 3,500 shares were not given as gift to Lexi during lifetime. Then total IST would have been, let's see what would be. We'll take 7,000 shares. The holding will be 100% because 7,000 shares are with Dawn and 3,000 shares are with the Juanita. So it means at the time of death, the holding is 100%. At the time of death, applicable share price on death is 24. Multiply this with 24. Multiply this with 40%. So the total IST comes 67,200. So IST saving due to gift of 3,500 shares to Lexi. This minus this. So basically there's a saving of 14,960. Now these things you have to also explain. So for explanation, please check, please see MS Word. Let's go to MS Word now. We have to go towards MS Word to explain. Okay, no issue at all. Just a minute. I have to take namaz break, and after namaz break, inshallah, I'll start. Okay, dear student, the namaz break is over. Now let us discuss the discussion part. Just a minute. Okay. Part A, okay, of Juanita. We just need to discuss relating to inheritance tax, how much the IST is saved due to giving 3,500 shares as gift to Lexi during the lifetime of Dawn. Okay. So let me tell you one thing. The first point is IST rate is 40% regardless 3,500 shares are given as gift during the life of Dawn or not, because because villa land, that is villa land, I believe, just villa. They have given villa as a gift because villa has used entire nil rate band. Okay, due to gift, due to gift only, impact comes on death state of state uh, of dawn. Basically, only impact comes on the death state, nothing else at all. Now, if shares are given as gift, during the lifetime, then IST, then total IST is 52,240. 52,240 can be seen on spreadsheet. Okay. If 3,500 shares are not given to Lexi as gift during the life of Dawn, then total IST is how much? Total IST is. Then total IST is 67,200. 67,200 can be seen on the spreadsheet. So total IST saving due to gift is 67,200 minus 52,240. It was coming how much? 14,000 something. 14,960. 14,960. 14,960. So simply you have to explain this area. We have given the reference also that you can go and check the spreadsheet. Okay. This is all about 8 marks. Now, let's discuss part B. What I'm going to do, dear student, I'm going to explain part B properly to you, but I want you people to, after listening my entire explanation relating to part B, I really want every one of you to solve part B, and I need answers of part B. If you are my enrolled students, obviously you can show the answer on the WhatsApp group. If you're not my enrolled student watching this lecture on YouTube, my YouTube channel, so I would request, I really want to see your answer on my YouTube. So let's see how many students they respond. Advise Juanita by reference to the increase in her trading income after tax and NIC contribution, whether it would be beneficial for her to continue to trade until 30th April 2023 rather than ceasing to trade on 28th Feb 2023. You should assume that any election which are beneficial to Juanita are made and should support your advice with a brief explanation of the available capital allowances in each case. You should assume that rates and allowances for the tax year 21-22 apply throughout the question. Where necessary, you should assume that there are 4 weeks in each week. Okay, let's read the question. Jonita has carried on a business as a sole trader for many years, preparing accounts to 30th June annually. Okay. Following Don's death, intends to cease trading and retire. Would like to cease trading on 28 Feb 2023. Stop. If she decides to cease the trading, to cease the business on 28 Feb 2023, it means this date falls in the tax year 22-23. This date falls in the tax year 22-23, in which case business will be sold to an unconnected person. Okay, is willing to continue to trade until 30th April 2023. If she continues to trade till 30th April 2023, this date falls in the tax year 23-24. When Lexi will be able to take over the business, does not anticipate having any other sources of taxable income in either of the tax year 22-23 or 23-24. Okay. Has taxable trading profit 51,000 for the year ended 30th June 2022. Now listen and listen carefully. This accounting end falls in the tax year 22-23. If she ceases her trade, her business in the on 28 Feb 2023, then this date also falls in the tax year 22-23. This date also falls in the tax year 22-23. Now you have two options to solve the question. Number one option, whatever profit comes till 28 Feb 2023, you can add that profit into 51,000 because both accounting and you can say fall in the same tax year. When both accounting and they fall in the same tax year, we just merge them. If you don't want to solve like this, it is still fine. Whatever profit comes on 28 Feb 2023, obviously that profit definitely falls in tax year 22-23. In that case, if you're not adding the profit of 51,000 into the profit of next 8 months, because from 30th June 2022 till 28 Feb 2023 there are 8 months. If you're not adding next 8 months profit into 51,000, then it is also perfectly fine. You just take the 8 months data and work on that. But you need to know one thing. Whatever trading profit comes in next 8 months, from that trading profit, you're not supposed to deduct any personal allowance. Why? Because personal allowance is then already deducted from this 51,000 profit. And this also falls in the tax year 22-23. Second, if we deduct 12,570 from 51,000, the answer comes more than 37,700, which means that this individual is a higher rate taxpayer. So whatever profit comes in the next 8 months, if there is any overlapping profit, obviously we'll deduct the overlapping profit from the last. Overlapping profit will be deducted from the last profit because business is ceased. So after deducting the overlapping profit, whatever comes on that, obviously if there is no other adjustment, then whatever comes on that profit, you have to pay tax, and applicable tax rate is going to be 40%. Second, when it comes to class 4 NIC, the applicable NIC rate will be 2%, and when it comes to class 2 NIC, which is paid weekly, 3.05 per week, and it is mentioned in the question in a month you can assume 4 weeks. So from 30th June 22 till 28 Feb 2023, there are 8 months. So how would we calculate class 2 NIC? We'll take 3.05 into 8 into 4, so we'll get the class 2 NIC. But so these are the few things which I wanted to discuss. Has budgeted tax adjusted trading profit 48,000 before capital allowances in the period ending 28 Feb 2023. So this falls in the tax year 22-23. Has budgeted further taxable profit 4,000 per month if Juanita continues to trade after 28 Feb 2023. Okay. Has overlapping profits from the commencement is 17,000. The tax written down value in the main pool was nil on this date. The market value of the asset on the main pool will be 6,000 at the end of the cessation, which means that if I'm just giving you the answer plan, I want every one of you to solve and just show your answer to me. If she decides to cease the business on 28 Feb 2023, so 8 months tax adjusted trading profit is 48,000. From this, in this 48,000, I will add the balancing charge. How do I get the balancing charge? Basically, tax return on value is 0, okay, and the market value of the asset is 6,000. So there's a balancing charge. Balancing charge will increase your trading profit. And these in the main pool, balancing charge as well as balancing allowance, they only come in the year of cessation, when business is seized or when you have sold the business. So obviously she is closing the business, she is seizing the business, so balancing charge will arise. So you will add the balancing charge, 0 minus 6,000, okay, and then you will be simply deducting the overlapping profit, because from the last profit you have to deduct the overlapping profit, which is 17,000. So you will get 37,000. On this 37,000, when it comes to income tax, applicable tax rate is 40%. Class 4 NIC rate is 2%, because due to having already trading profit of 51,000, definitely class 4 NIC rate is now 2%, which is applicable on this 37,000. Okay. And what else? When it comes to class 2 NIC, how will you calculate 3.05 into 8 into 4? You will get class 2 NIC. Okay. If she continues the business till 30th April 2023, then what happens? Obviously, tax adjusted trading profit, which is already given to us, it is 48,000 till 28 Feb. She continues the business till 30th April, means March, April, 2 more months. So I'm going to add next 2 months profit, which is 4,000 per month given in the question. I'll reach at 52, 56. Okay. Now, there will be no balancing charge. Why balancing charge will not arise? Because when on 30th, if she continues the business on 30th April, she will uh, basically transfer this business to her daughter, Lexi. Lexi is a connected person. When you are transferring your business to a connected person, then no balancing allowance or charge arises, because then we transfer the business on tax written down values. So basically no balancing allowance, no balancing charge arises. So simply balancing charge will be 0, because Jonita is transferring the business to the connected person. Simply you will be deducting overlapping profit. Overlapping profit is 17,000. Okay. Whatever comes from this 56,000, I'm going to deduct 17,000. Okay. Let's see what comes. 56 minus 17. We are getting 39,000. Okay. Now from this 39,000, dear student, you'll be deducting the personal allowance 12570, because this falls in a different tax rate, 2324. So after deducting the personal allowance, you will get the taxable income. Let me tell you, 39,000 minus 12570. 39,000 minus 1250, you will get taxable income 26,430. Entire taxable income falls in basic rate band, so obviously you are supposed to apply the tax rate 20%. When it comes to class 4 NIC, class 4 NIC is applicable on 39,000. But in case of class 4 NIC, we know that 9568, the NIC rate is 0%. From 39, you will deduct 9568. These limit will be given to you in exam into 9%. Whatever comes, you have to write this. When it comes to class 2 NIC, dear student, the class 2 NIC will be for the 10 months, because now she's continuing the business till 30th April. So you will take 3.05 into 10 into 4, whatever comes you need to write. then you need to compare. If she ceases the business on 28 Feb 2023, what is going to be her income after tax, trading income after tax? Second, you need to compare that trading income after tax if she continues the business till 30th April 2023. What income after tax she will get? So in out of these two, option 1 and option 2, you will obviously advise the option where her income is higher. For example, if she's getting more income in case of continuing the business till 30th April 2023 and then transferring the business to Lexi, then simply you will advise her to continue the business till 30th April 2023 and then simply transfer the business to Lexi. If obviously, let's say, if income after tax, trading income after tax comes more in the option 1, then you will advise her option 1. So I really want every one of you, and I really appreciate, obviously those students that are enrolled with me, you can share your advice on my WhatsApp group. Those that are not enrolled with me, they are watching my lecture on YouTube. I really want to see the answer, your recommendation in the comments. So thank you very much, obviously, for watching this lecture. Have a nice life. Assalamu alaikum.